Good morning, good afternoon, good evening, and welcome to our 315th weekly webcast. Now, if this is the first time you're joining our webcast, welcome. If you've been with us before, welcome back. Now, the way this works is this is an AMA, like you see on Reddit, meaning ask me anything. You can ask me business questions, career questions, investing questions, startup questions, any questions you want to, including personal growth questions. And my humble goal is to help you take your career or personal life to the next level. Without further ado, let's begin. And thank you. One quick housekeeping announcement. Next week, I'm going to be releasing a massive finance bundle on my website, harounmba.com, with the sole intention of helping you get a job in finance or take your finance acumen or skill set to the next level. It's going to be a lot of fun. All right, let me get to your questions here. First one, Tabo wrote, hi, Mr. Haroun. Chris, please. Hope you and your family are doing well, likewise. I understand this is something you're working on in private. Yeah. But if you can give a brief summary of what are the footnotes in financial reports. Yeah, actually, it's not in private. What I'm doing is I'm working on a new course that's going to be added to my MBA degree program on my website. And what I'm doing is I'm helping people to understand how to analyze financial statements by looking at the footnotes. And the product is going to look like this. Okay, so when people analyze financial statements, one of the biggest problems they make is they only look at the three big financial statements: income statement, balance sheet, and cash flow statement. But they don't analyze what are called the footnotes. And these are crucial. They're important because when you look at the annual report, which is also called the 10K, there are little numbers beside, footnote numbers beside a lot of the items on the financial statements. And those are footnotes. And there's usually between 10 and 15 categories of footnotes that you can do due diligence on. A lot of off-balance sheet items, or what debt is due in the next 5 years or so. And so per this graphic I'm showing you right here, this is what the course is going to look like. We're going to do massive footnote analysis. You're going to get a one-page executive summary. And you're also going to be able to analyze and quantify everything from the footnotes, including the MD&A, meaning that management discussion and analysis. So make sure whenever you're analyzing financial statements to please don't just look at the three major financial statements. Also look at the footnotes, which are found in the 10K. If you list a company, I can do a real-time footnotes analysis for you by going to sec.gov on any firm if you want me to. Okay, next question's from Ray. Hey, Ray. Ray wrote, hey, Chris, thanks for mentoring us with such devotion. My pleasure. Thank you for being here. Here are some questions. ChatGPT is doing a great job when reading and analyzing 10Ks from the SEC. Any comments? Yeah, absolutely. So you have to be careful when you're using any AI product analyzing financial statements, because quite often these AI products hallucinate, meaning they're confidently wrong. So you've got to double check everything. Now, one of the products that I use for analyzing financial statements is Claude.ai. Now, Claude.ai is not available in every country. If it doesn't work in your country, then please use a VPN. And what you can do with Claude.ai, you can also sort of do this in ChatGPT, is you can upload financial statements and then ask questions. So what I do is I upload the 10K or annual report from any company to Claude.ai, and then I say, give me the risks in a table. Or what you can do is upload a couple of 10Ks, meaning annual reports, and say, create the income statement for the past 10 years. And it'll pull the data directly out of the 10Ks. Now, please double check the data because, again, it quite often is confidently wrong. Now, last year, I interviewed Brent Thill, who's the #1 software and internet analyst on the planet. He works at an investment bank called Jefferies. And one of my students during that interview asked, do you guys use ChatGPT and AI products? And he said, not yet. We're very careful with it because some junior employees might over-rely on that, which is going to be okay in the future, but not now, which could lead to material issues. So always double check the data, please. Okay. Next question is, when I look at CRWD, ticker, okay, stats in Yahoo, I see a huge gap between trailing PE, meaning price earnings, and forward PE, meaning looking at the earnings estimates next year, price over earnings. 1 year ago, it was 10 times difference. 78 was expected. 400 is now. Does this mean the expectations 1 year ago were wrong? Yeah. So I never want you to rely on any estimates from any financial analysts. Okay. I always want you to do your own research. And don't ever listen to me in terms of what stocks to buy. Instead of providing you the fish, I teach you how to fish. Now, when you forecast financial statements and use PE, I want you to value the company based on your earnings estimates in 5 years, okay? Don't rely on Wall Street, okay? They're quite often wrong. And I don't want you to follow the herd. I want you to do your own research. Otherwise, what will happen is if you listen to other people, you'll make the cardinal sin of investing. And Warren Buffett once said that the New York Stock Exchange is the only store in the world where consumers sell stuff when it goes on sale. So think about that. So why my estimates have come down for that company or any company over the past 6 months or so? Well, it could be because Wall Street is forecasting a recession this year. Okay, so according to some investment banks, there's a 90% probability that there could be a recession this year. And I think that came from JP Morgan. Now, a recession is defined as 2 consecutive quarters of negative year-over-year GDP growth. Don't fear a recession. Also, don't fear a stock market pullback. Use that as an opportunity to add to positions. And whenever you analyze stocks, and I provide you with all the tools and templates you need to analyze stocks and come up with your own target price, I want you to focus on your target price 5 or 10 years from now. And so when I used to manage money professionally at hedge funds, I used to always think to myself, I don't care about the path. I care about the destination. Okay, so try to think long term. Okay, and I promise you, you'll be much wealthier in the long run if you do that. Yeah. All right, next question is there a PEG, meaning price earnings divided by growth ratio? Is there a PEG so high that it'll stop you from evaluating the company? Where is the sensible border that even if the net income is perfectly growing, it won't make up for the initial high price, meaning a PEG over 4 per your question? Yeah. So let me take a step back and explain PEG briefly. So PEG refers to the price earnings ratio divided by the growth rate. Okay, so companies that are growing faster should have a higher PE. Now, a PEG ratio, I'm going to give you an example. Let's say a company has earnings growth of 15%. And the PE is 15 times. So that's PEG, PE of 15 divided by 15, that's a PEG ratio of 1. And usually if it's 1 or below 1, it's a great investment after you've done your research. However, don't look at this year's earnings or next year's earnings for growth. I want you to look longer term. Okay, and I can pull out financial models and show you an example of how if you want me to. Always come up with target prices in 5 years. And value companies based on your earnings estimates in year 5. So the price today divided by your EPS estimate in 5 years. Okay, that's how you should value companies. And there's 3 or 4 different ways to value companies. I can go through them in real time with a financial model if you want me to. All right, next question is, in Yahoo Finance, there's a PEG ratio. Sometimes it's 0.8, sometimes it's 4. Is the current PE over forecasted earnings year-over-year growth? Should we be scared when we see 4? Yeah, again, I don't want you to look at the Yahoo Finance estimates. I want you to build your own financial model, which is a lot easier than you think. Now, when you build a financial model, a lot of people get scared. They get intimidated. It's easier than you think. What you're going to do is you're going to start with the income statement, okay? And all you're going to do is you're going to spend most of your time forecasting revenue, which is the top line of the income statement. That's why people say, what's your top line growth? And so you're going to look at historical trends, okay? And as you look at historical trends, say this is the past 5 years, okay? What do you think the next year is going to be? Probably up here, right? An object in motion will stay in motion, okay? Now, as you're analyzing historical trends for revenue growth, if you see that revenue growth steps up huge 1 year, it's probably because they made an acquisition. And the only way to understand if they made an acquisition is to listen to the quarterly earnings call, which I teach you how to do in my programs. Also read the 10K, the Qs, the 8K, etc. Okay? And you got to watch out for non-organic growth because that will screw you in terms of coming up with a valuation. All right, so we forecasted revenue. Then the other red items here, for the most part, are a percent of revenue, right? And so you look at these 3 line items here and the cost of goods sold, and you look to see what they are as a percent of revenue historically. And if they're coming down slowly every year, then model that going down every year, right? There's much more to it as well. This is just the basics. And then all of that is going to get to your net earnings. Now, your net earnings, it's the bottom line of the income statement. Hence that when CFOs say, what's your bottom line growth? Well, it's the bottom line of the income statement. Now, net income is also profit. It's also called earnings. Then you take earnings per share. Then you're going to forecast that out 5 years. You're going to take the price today divided by your earnings per share estimate in 5 years. Okay. And that's how you invest. And come up with a target price based on the growth between years 4 and 5. So if between years 4 and 5 earnings is growing at 20%, then slap on a PEG ratio of 1, meaning 20 times earnings. Your target price should be 20 times earnings in year 5. Again, I can show you a demo of this in real time if you want me to. Now, the smartest investors in the world, let me get a book here for you guys. The smartest growth investors in the world, they value companies based on their earnings estimates in 5 years. Don't look at earnings this year or last year or next year, because everybody else does. The longer the view, the wiser the intention. That's what Warren Buffett said. Now, this is a great book here by Peter Lynch. Please read it. It's called One Up on Wall Street. He was a quintessential growth investor that managed the flagship Magellan Fund for Fidelity back in the 1990s. He's long-term focused. He also invests in what he understands. Only invest in what you thoroughly understand. Okay. All right, next question I've got here is, and welcome to everybody listening on Spotify podcast as well. Okay. And if you can't join this call weekly, you can always listen to it on all podcast networks. Thank you. All right. Next question is about Tesla. The growth of normalized EBITDA is very small for Tesla. In 2023 versus 2024, EPS is decreasing, income is decreasing for 2 consecutive years. How would you comment on that? Yeah, so we all see the news, and we see that Elon Musk has been really distracted by working on the Doge team. Okay, now this is nothing new. Whenever you see a CEO or founder of a company have a new pet project, what hedge funds usually do, and what I used to do, is look to short the stock, okay, amongst other factors. So let's go back in time to a couple of years ago. When Elon Musk bought Twitter, now called X, he really took his eye off the ball, okay? And then Tesla's innovation died temporarily, and the stock pulled back materially. The same thing with Doge. The same thing when the CEO or founder of a company buys a sports team. It's true. You can look at the historical data through machine learning or regression analysis, right? So that's what's happening with Elon Musk right now. Now, the board... according to people familiar with the matter, that's the Wall Street Journal, they say when they have insider information, which apparently the media is allowed to have as long as they don't transact on it. But according to people familiar with the matter and the Wall Street Journal, the board of Tesla is looking for a replacement for Elon Musk, right? And I don't think they're going to replace him, because I actually think that within 1 to 2 months, this is my call, that Elon Musk is not going to be heading up Doge anymore, and he's going to be focusing entirely on Tesla, SpaceX, and his other companies like the Boring Company, etc. So I think that if Tesla gets decimated because of this, it might be a good long-term investment. And the way I look at Tesla right now is I think it's a broken stock and not really a broken company, right? Now, if Elon Musk were to leave the company, I would never invest in Tesla. I don't invest in companies when the founder has left. And it's debatable whether or not he was a founder, but I kind of consider him as is. Don't ever invest in a stock if the founder has left. Okay. Now, if the founder leaves and is somewhat engaged a little bit, that might be okay. But the second a founder leaves a company, investors should run for the exit, as I wrote in my VentureBeat article online years ago. You can read that if you want to. The reason why it sucks to invest in a company when the founder leaves is because the founder is very long-term focused. Right? They don't really, sometimes they don't get on earnings calls. They don't care. They're very long-term focused. But once the founder leaves and a new CEO comes in, that CEO is slave to quarterly earnings. They're very short-term focused. They don't have great long-term strategic vision. Now, in technology, with tech stocks, whenever you see a tech company becoming a little bit less relevant, it's almost always game over. Okay, and there's one turnaround per decade that works in tech. Again, whenever you see a tech company becoming a little bit less relevant, it's usually game over. Don't get seduced into buying the stock because valuation looks cheap. Okay, and there's plenty of examples. You know, years ago, Yahoo losing share to Google, Research in Motion losing share to Apple, etc. Okay, and Ray wrote, what is the minimum profit margin, current or forecasted, for you to find a company interesting, 5 or 10 times, etc.? Yeah, let me explain this. There's a couple ways to look at profit margin, okay? There's gross profit margin, there's operating profit margin, also called EBITDA margin, and there's net profit margin. Okay, so whenever you hear the word something margin, It means net income over something. So net profit margin is net income over revenue. Now, it all depends on the sector. Okay, now net income over revenue is profit margin. Now, for the rest of your life, whenever you see a formula, I want you to think this. The denominator is always a number one. What does that mean? Well, that means for every $1 in revenue, how many pennies of net income are they making? So if the net profit margin is 5, that means for every $1 in revenue they're making 5 pennies. So what's a good net profit margin? Well, it all depends on the sector. If you're in the retail sector, like grocery stores, for example, sometimes it can be 2 or 3%. And this is why a lot of retail companies can't compete with Walmart or Amazon, etc. If it's a tech stock, like a software company, it can be over 20%. But what people love to look at instead of that is something called operating profit margin or EBITDA margin. Okay. Now, operating profit margin means operating profit divided by revenue. Okay. And sometimes people call this EBITDA. Okay. Whoops, divided by revenue. This is where I wish I had 3 hands. Revenue in the bottom here, sorry. Operating profit divided by revenue, or EBITDA margin. Okay, that means for every $1 in revenue the company has, how many pennies of operating profit or EBITDA do they have? And the reason we look at that, now for software companies, the gold standard is getting to at least 30%. The reason we look at EBITDA, which is earnings before interest, taxes, depreciation, and amortization, is because depreciation and amortization are non-cash expenses. Okay, so you want to look at cash earnings, for example. And the reason you look at before interest and taxes is because you want to be able to compare companies in different countries that have different tax rates and different interest rates. I can go into more detail on that if you want me to. All right. Next question is, what do you do and what do you conclude if shares are diluted? Yeah. So shares being diluted. So earnings per share means net income divided by number of shares. Dilution means if you increase the number of shares a lot, denominator goes up a lot, this ratio earnings per share goes down. What do you do if shares are diluted? I'm looking at block financials and I see that despite the rise in normalized EBITDA, EPS is falling, I guess, due to more shares. So what? Yeah. So you're going to have to look at the use of proceeds if they did a share offering, meaning if they hired an investment bank to sell more shares in the company. If it makes sense long term, meaning the use of proceeds is to maybe invest in R&D and grow the company, it might be worthwhile, but you've got to look at the use of proceeds. Okay. Usually what happens is this. When companies go public, right, they like a tech stock, for example, the way they pay their employees is through stock options, right? So they actually create more shares. It doesn't cost them any money to do so. And I don't care if that happens, as long as it's not more than 1 or 2% increase per year. I don't care if that happens because I want the employees to have golden handcuffs, meaning they're tied to the company and they can't leave because of shares. Now, the way it works is if you work at a company and they give you options, they usually give you options every year, but you can't cash in those shares except every 4 years, right? And that's referred to as vesting. So you have golden handcuffs, you're stuck, right? And that's okay. Now, for more mature companies, especially in tech, usually these companies are very cash rich and they use their cash to buy back shares. So for the most part, very large tech companies have the number of shares going down because the CFO is buying back shares because the Trump administration and the Biden administration won't allow big tech companies in the United States to buy smaller tech companies for antitrust reasons. I can go into more detail on that if you want me to. Okay, next question is, do you ever compare ROIC with the cost of capital? Yeah, I don't like looking at return on invested capital very much because on the denominator, there's 3 variables. I like to keep it simplistic. I like to look at return on assets and return on equity. Okay, and return on assets and return on equity means this. Okay, return on equity is for every $1 in equity, how many pennies in net income is the company making? Same thing with return on assets. It's a much simpler way to do it than looking at ROIC, in my humble opinion. And I can show you real-time examples if you guys want me to as well. All right, next question I've got here is, when building a financial model, do you hard copy the data from the income statement from SEC filings, or is there an easier way? Yeah, there are websites you can go to that will be able to download this stuff directly for you. There's plenty of them out there. BAMSEC is one of them. Let me show you. A lot of people on Wall Street subscribe to this. You can get a free subscription as well. Okay, so I'm going to go to bamsec.com. I think this is it here. Yeah, bamsec.com. So what you do here is you can look at financial statements, okay? And then you can just download the data directly instead of going to sec.gov. I prefer to go to sec.gov and look at the 8Ks and the 10Qs, the 3 10Qs released per year and the 1 10K released per year, and use that data entered directly into my model because I don't trust any other source. Yeah. Next question is, what does it mean to be bullish on a stock? So bullish means, so think of in Spain running with the bulls, right? Bullish means, oh my gosh, the stock's going up a lot. Bearish is the opposite. Think of the opening scene from The Remnant. Sorry for putting that in your mind. Bearish is bad, yeah. And then you wrote, does being bullish on a stock mean it is not 5% of your portfolio yet? Yeah. So my personal risk management metric that I tell my clients is, if you're going to invest in single stocks, what I want you to do is this. I don't want your portfolio to have less than 20 stocks. And I don't want any one stock in your portfolio to be more than 5% of capital. Okay, so that's 20 stocks. And the reason I say that is it's just good risk management. And I don't care if a company has a cure for cancer. It still stops at 5%. In addition, I don't recommend that my clients and my students have more than 20% of their capital in a portfolio in one particular sector. For example, technology, industrials, healthcare, cyclicals, whatever it might be. And that's good risk management. And for those of you outside the United States, I would also be careful not to have too much exposure to the US dollar. Now, in terms of asset allocation based on your age, so there's an old private wealth management school of thought, which is this. You take 100 minus your age, and then that will help you understand what should be in riskier growth stocks. And I say riskier with an asterisk beside it. So for example, if you're 70 years old, 100 minus 70 is 30. That means that 30% of your portfolio should be in lower risk stuff, like value stocks that Warren Buffett invests in, or AAA rated bonds, okay? So 70% should be in that, 30% in growth stocks. If you're 20 years old, 100 minus 20 is 80. You've got a lot of time to make up for losses. So in that case, if you're 20, 100 minus 20 is 80. 80% should be in growth stocks, in my humble opinion. Do your own research. And 20% in value stocks. Yeah. Next question from Ray is, what do you pay attention to when you open an advanced chart of a stock, say Microsoft? Yeah, a couple of things. So number one, whenever you do investment research on a company, I always want you, and I'm going to show you my template here I provide my clients. Okay, and if you're interested in joining one of my programs, set up a call with one of my salespeople by looking in the description of this video. But I designed this when I worked on Wall Street. Okay, so when I analyze companies, I look at qualitative research, quantitative research, and financial research. And what comes out of this is a one-page executive summary that you can take to your interviews if you want to. And when you look at analyzing stocks, this is dummy data here. You look at fundamentals first always, okay? Then you look at valuation second. And then a distant third is you look at technical analysis, okay? And that's why I left it here as step 99. Don't ever base your investment opinion only on technical analysis. Now let's take a look at an example. And you asked me to look at the chart of Microsoft. Okay, so assuming you've looked at the fundamentals and the valuation analysis on Microsoft, I'll show you how a lot of professional investors look at the chat. That's how they call it in South Boston. Okay, so let me go here to all. Okay, give me 1 second. All right, hold on a second here. All right, actually, I'm going to go to 1 year. It's easier. Yeah. All right. So what people look at when it comes to the chart from a technical analysis perspective, one of the first things they look at is the relative strength index. And that measures whether a stock is overbought or oversold. Let me see if I can add that here. Hold on 1 second. Technicals. Really? You're going to make me upgrade? Screw you. Let's go to indicators. All right, RSI right here. Don't pay for nothing, guys. All right, so we're going to look here at the RSI. Red is bad. This will make sense to you in a second. Green is good. And that's going to add a chart to the bottom. Okay, it's kind of tough to see, but right here, you'll see that down here, okay, down here, you've got 20. So when the stock is closer to 20 or 30 down here, that's usually a buy indication. And when the stock is closer to 70 or 80, that's a sell indication. Doesn't always work. Okay, do your fundamental research first. So for example, if we go back in time to December 17th, Microsoft was overbought at around 70 or so, right here. So traders sold the stock. Okay, and then if we go down here, okay, you see that on April 7th, Microsoft was oversold at an RSI, I don't know if you can see it behind me here, of 24. So investors bought the stock. Okay, so that's one of the things you'll look at. You can also look at moving averages as well, like the 50-day and 200-day moving average, which I don't think is going to have that much. It's not going to help us that much here. But people also look at trend lines. So, for example, and I'm so sorry for those of you listening on the podcast, but if you look at trend lines, so if we go back in time to 2023, okay, so there's a trend line here, okay, and if it breaks down through the trend line on the right side, then some traders might be less bullish on the stock. And I can draw the trend lines if you want me to, but I don't want to spend too much time on that, unless you want me to. Okay, next question I've got is, momento por favor. Okay, Thabo wrote, last time I asked you about McKinsey valuation model, you referred to it as trash in, trash out. Yeah, okay. So what I mean by that is this in general, okay? If you're looking at a valuation metric, like discounted cash flow, and there's too many unknown variables, then the probability of you coming up with a good target price is low. Let me explain why. This will be a really simplistic example. If I say x plus 1 is 3, what is x? It's 2. If I say x plus 1 plus w plus bricks plus coffee plus medicine is 3, what is x? No idea. So the more independent variables you have, from an algebraic perspective, in a valuation formula, the higher the margin of error. Yeah. And then you wrote, my question now is, do you at least look at ROIC and WACC spread to evaluate shareholder return? Yeah, so let me show you how I analyze it. Okay, and this here is an excerpt from the Finance Bootcamp product that I'm just about to release on my website. All right. So after we forecast financial statements, we value the company using DCF. We also, if you want to, we also value using price earnings, price to revenue, and then we take a blended average target price of all three. Why? Because one of your valuation methodologies is going to be way off, and you want to minimize the margin of error. Okay, usually DCF is off. My favorite is PE. Now, when we look at financial ratios, these are the ones I look at here. Again, this is available to my students in my Finance Bootcamp program. Set up a call with my team per the link in the description of this video to learn more. When I look at ratios down here, so ROIC, I like to look at return on assets, return on equity. And the reason is it's a much simpler formula. So return on invested capital has 3 items in the denominator. This has 1, okay? And whenever you hear the term return on, it means net income over something. So I like to look at return on assets and return on equity. And I like to see growth over time as well. And this is linked to real data. I can go through that if you want me to. Okay, let me go back over here to Big Chris mode. Let's do this camera angle now. My desk gets progressively messier the longer these webcasts go on. But I love doing this. Okay. All right, can you name 5 to 10 financial ratios for screening stocks so we can create a funnel and we don't need to waste 10 days in fundamental analysis, but start with a probable winner? Yeah, of course. So what you can do, and I'll show you the ones that I look at here. Okay, so I'm going to give you 5 to 10 per your answer. So the first thing I look at are profitability ratios right here. Okay, so, and we kind of talked about this earlier on today's webcast. So that means gross profit over sales. Sales and revenue is the same thing. EBITDA over sales, net income over sales. Remember, with the denominator, always think the number 1. So net margin is net income over sales, which means for every $1 in sales, how many pennies of net income are we making? Higher is better. We want to look for growth over time. Okay, those are profitability ratios from the income statement. Next up, we look at the balance sheet. Okay, we look at what are called liquidity and solvency ratios. So the first ratio we look at is the current ratio, which is current assets over current liabilities. We want it to be going up. But the problem with looking at the current ratio only is that the current ratio, and I'll come back to this in a second, the problem with looking at the current ratio is that you're not accounting for inventory. Now, inventory can destroy a company. So, for example, back in the 1980s, there was a great movie called E.T. I'm sure a lot of you saw it. My mommy took me to it. My sister Katie, I miss you, Katie. And what happened was Steven Spielberg allowed the Atari Corporation to make a gazillion of these games. I think it was 1983 Christmas. And I got this for Christmas. Thank you, Dad. I love you. But the game sucked. It was so bad. And they made so many of these things that they had to bury this inventory in the desert, right? And I got this on eBay. It's a collector's item now. And that caused the whole video game sector to go belly up until Nintendo came along and reinvented the entire sector. I have a lot of case studies on Nintendo in my MBA degree program. So the reason I'm mentioning this is that we want to look at another financial ratio, which backs out inventory. Okay, never start a company where you're reliant on inventory. Okay, unless the customer pays first, like with Dell Incorporated, where you buy the computer first, you send the cash, then they build it. Okay, just in time, Edward Deming's philosophy. So let me show you that ratio right here really quickly. So then you got the quick ratio here. Okay, that's current assets minus inventory divided by current liabilities. And again, you want that to be a high number going up over time. Then you look at debt to equity. Okay, you don't want too much debt, right? So you want this to be going down over time. Then let's talk about cash flow ratios. Okay, this is from the cash flow statement as well as from the income statement. Okay, and these are all linked to my other cells, meaning the other financial statements. So the first one you look at is operating cash flow over revenue. Okay, and that's kind of like net profit margin. You want that to be going up over time. And then you want free cash flow over revenue. Free cash flow is operating cash flow minus CapEx. Okay, and I can explain in more detail if you want me to. Lastly, we look at the return on ratios. Whenever you hear the term return on something, it means net income over something. We look at return on assets as well as return on equity. And I personally don't like looking, again, at ROIC because there's three variables in the denominator. Okay, let me go back here. Move on to the next question. Yeah, and when you're trying to pick stocks, I wouldn't just screen based on ratios, right? Because garbage in, garbage out, you might be looking at awful data online or some analyst forecasts. I always want you to think this before you start researching a company. Okay, we're gonna keep it simple. Let's take a step back. When you're researching a company or a sector, I want you to ask yourself this. 5 years from now, is this company or the sector it's in going to be more relevant or less relevant than it is today? Keep it simple, high level. Then what you can do is once you identify the sector, then you can start doing fundamental research, building out your financial model, etc. Now, a great way to do this is to look at ETFs. So I'm going to give you guys a free resource right here, which will help you to screen stocks. Okay, this is a better way to do it. So I want you to go to etfdb.com. That's etfdatabase.com with me. It's a free resource. And let me make this bigger. And let's go to ETF by type. Okay, so you can look at all the themes, okay, possible. And then once you find a theme that you like, then you can look at the components. Okay, so let me give you a quick example. So let's say that you want to invest, I'm going to make this up, in agriculture. Okay, I don't know whatever your theme is. Then I want you to get, oh my God, that's the coolest sticker I've ever seen, moo. So here's an ETF. Let's say you're bullish on agriculture. Okay, so what you're going to do next is you're going to look at this ETF. Okay, and then you're going to look at the components. And just for fun, let's go to Yahoo Finance and type in that ticker. We could also do it on the other website, but I wanted to mix it up here. So ticker moo. It's great branding, man. Then you're going to go here to the holdings. Okay, so say you're bullish on agriculture. You're going to look at the holdings, and then you're going to do research on these companies here, like Archer Daniels, Midland, John Deere, etc. Okay? All right. And if you don't have time to do individual stock research, what I recommend doing is just buy ETFs. And please do your own research, but I'll tell you what I do. When I'm not sure where to put my money, I usually put it in ticker VOO, not MOO. VOO is the S&P 500. The fees are low at 0.03% per year. That means for every $100 I invest, I'm only paying 3 pennies per year in fees versus mutual funds, which are a ripoff. Never buy mutual funds, where the fees, including hidden fees, can be over 5%. Okay. Next question is, should one stock be no more than 5% of your portfolio or your net worth? No, of your portfolio. Yeah. So if you have $100 to invest, no stock should be more than $5 of that. Yeah. But your number one priority should always be to buy real estate, buy your house if you can. And it's the best investment you'll ever make, buying a house. And let me show you a quick example here. So this is one of my electives, a complete real estate course, which is only available to my MBA degree program students. So I'm going to show you something that is going to blow your mind. Okay. So let's say that you're spending $2,200 per month, okay, on rent. And let's say you rent for 50 years. So 2,200 times 12 months times 50 years. That means that you're going to be spending $1.32 million. Okay. Now, assuming, and yes, this is aggressive, but assuming that real estate goes up 15% per year, and the reason I write it that way, I know a lot of people are going to push back on this, is because you get the interest deduction, okay, for when you invest in rental properties, plus you get depreciation deduction and much more. So my question to all of you is this. If you were to invest $2,200 every month for 50 years at a 15% return, how much money would you have in 50 years? Obviously more than that. You ready? This is going to blow your mind. You'd have $303 million. Okay, that's the time value of money at work. Okay? And so that's why I want you all to buy real estate when you can. It's hard to do it at a young age. Like for me, for example, I lived in New York City. It was too expensive to buy real estate there. So I had to wait until, I was like 31 or something to buy my first place. And I actually bought right after 9/11. And the reason I did was because I lived in New York and I saw the planes going. It was terrible. But the reason I bought real estate then was because nobody else was. You've got to be greedy when others are fearful, and fearful when others are greedy. And I say it with love in my heart, right? If you buy the same stock or asset everybody else loves, you're buying it at the peak. Okay, so you got to think like Wayne Gretzky. I'm a very proud Canadian, and actually, I worked actually at the same time as Mark Carney, the new Prime Minister, at Goldman Sachs. He's great, by the way. I can talk more details about him, although I'm more of a conservative than him. But Wayne Gretzky was successful, not because he skated to where the puck is, but rather because he skated to where the puck is going to be. By the same token, I want all of you to invest in stocks or real estate that people are going to like. And that's why I try to make you think very, very long term when you invest. So Warren Buffett, whenever he invests in a stock, he's owned Coca-Cola since around 1990. He always tells himself, after I buy this stock, I'm assuming the market's going to be closed for 10 years. Now, of course, he knows the market's not going to be closed for 10 years, but that's how long-term focused you have to be. And we've all made the cardinal sin, myself included, of selling a stock because it went down. And you look back and you're so upset with yourself, or at least I am, for selling that stock in hindsight. Because here's what the stock chart looked like. I sold it because it went here. And it just keeps going. Like, don't care about the path, guys. Care about the destination. Okay. And don't check stock prices every day. It's a big waste of time. Just think long term. Now, if all you did was you took your retirement savings, your 401k, every year, let's just say it's about 22K, and you put it in the S&P 500, if that's all you did, then in 20 years, you'd have over $1 million. If your spouse did it as well, then in 20 years, you'd have over $2 million. Don't day trade. Now, if you have children, and by the way, I want you to all have an accountant, don't do your own taxes. It's like doing surgery on yourself. The CPA profession exists for a reason. But if you have children, like I do, and they're older now, 3 boys, it's fun. But if you have kids, what I want you to do also is the second they're born or even before, I want you to invest in their educational savings account. Okay? And this works in a lot of countries. And in the United States, you can invest, I think it's closer to 15K a year or something, each year tax-free. It works just like a 401k. The beauty of doing that is when your kid is 18, right? So if you maxed out around 15K every year, it's hard to do every year, I know, for one kid, then in 18 years, you had 700K. If you did it for all 3 kids, you'd have 2.1 million, right? So if you maxed out your educational savings account and your 401k with 3 kids, you'll have $2 million for you and your spouse in your 401k, plus $2.1 million for kids, $4.1 million in 18 years. Plus you get the upside in your house. So I want you to max out. And the great thing about educational savings accounts is that you can actually let your kids take it out tax-free to pay for tuition. So my son Andrew, he's I think 3rd year at Berkeley, and so that's what we're doing. We're paying for his university that way. He just got a job actually in investment banking at a top 4 firm. Very proud of him. This is Matthew. He's working for an asset management company in the summer. He's older now. He's in university. This is Dylan, who's 15, going on 40, the youngest one, and he's at public high school here where I live. All right, let me go to the next question here. All right, and whenever I feel like I'm getting a cold, I'm going to show you what works for me from a biohacking perspective. Do what works for you. Talk to a doctor first, right? So I feel like something is coming on cold. So the second I feel like I'm about to get sick, what I do is I pop a couple of airbornes. Okay, so it's just vitamin C or vitamin C for you guys in England. So I'm going to put this here. Okay, and I'll drink this. And then what I also do is there's a product I use. Again, do your research first. My little sister Elizabeth told me about, called colloidal silver. And what you do is, and talk to a doctor first and all that crap. What you do is you put this under your tongue for about 10 seconds, and it stops you from getting sick. All right, teachable moment. Let me move on here. Next question. All right, Javesh. Hey, Javesh wrote, do you think we're currently in a recession or possibly heading towards one? I think greater than 50% probability. Yeah, I really do think so. Now, if you look at the ports in Long Beach, so what a lot of people do in Southern California, a lot of investors, is they look closely at the ports, meaning import-export in Long Beach, California. It's a massive port. We have one here in Oakland. And if they see the amount of trade or imports is going down, then that might be a leading indicator or a channel check, so to speak, that we're going to recession. Now, traffic is down 30% right now in Long Beach. Okay, obviously because tariffs on China are temporarily well over 100%. So I would think there's a good chance that we're already in a recession. Again, a recession is defined as 2 consecutive quarters of year-over-year GDP decline. GDP is kind of like revenue for a country. Yeah. And then you wrote, do we think we're going into depression? No, I don't think so. How do I prepare? I don't really care because I'm long-term focused, right? So if stocks get hammered and if the VIX, spikes to 70 or so, great, I'll buy more. I don't know the path, but I know the destination on stocks longer term. Okay, yeah. All right, but if you're shorter term focused, and I hope people are not, but what you can always do is you can transition out of growth stocks and into consumer staples. Stuff like Campbell's Soup, ticker CPB, which has a beta well below 1, and people still eat soup in recessions. For example, soup is good food, good dividend yield too. Next question is, what is better, to aim at some of the well-known growth companies or do a search for unfound treasures in the Russell 3000? Yeah, I like that. Yeah. So what I like to do whenever I invest in stocks, I like to look at small and mid-cap stocks. And I like to invest in what I humbly believe are 5x5s. What does that mean? That means a 500% return within 5 years. Now, I do a lot of research. Am I sometimes wrong? I'm almost always wrong. But if the stock doesn't go up 5 times and it goes up 3 times, I'm usually happy. Now, the way to do that is as follows. Step 1, ask yourself from a high-level perspective, like forest from the trees, top down. In 5 years, is this sector or the stock it's in going to be more relevant or less relevant than today? Step 2, you can look at that Russell 3000 index and find companies in that sector. Or what you can do is you can look at the IBD 50. Okay, now Investors Business Daily is founded by a brilliant man, William O'Neill. He passed away. I used to be his client years ago. But Investors Business Daily, what they do is they come up with a list of growth stocks they've done research on. Now be careful, because Investors Business Daily stocks do horrible in a bear market, but they do really well in a growth market, meaning in a bull market. So do the research first. You can look at the IBD 50. You can search for Investors Business Daily. I used to get the newspaper sent to me every day when I was younger. I'm dating myself. I used to read those things. And that can certainly help you out. Yeah. Now be careful because they're a little bit too focused sometimes on technical analysis, but they do find a couple of hidden gems. Yeah. But you got to be very long-term focused if you're going to invest in those companies. Yeah. And when you do research on IBD stocks, meaning Investors Business Daily stocks, I always want you to use my 100-step investment research dashboard to do your research, okay? And if you guys want to learn more about this, just go to the link in the description. Thank you. All right, let me get to the next question now. All right. Okay, Ray wrote, how do you extract the income statement from Yahoo in Excel? It places all the cells in one column. Yeah, do not do that, ever. Yahoo is quite often very, very wrong when it comes to income statement, balance sheet, cash flow statement. Go directly to the source, meaning sec.gov, type in the ticker name, and get it from either the 8K, okay, the quarterly earnings, or from the 10Q, or from the 10K, which is audited financials. Okay, and make sure to read the footnotes. And then Ray wrote, are you saying that because the founder is not there, Amazon is no longer a good investment? Yeah, this one is debatable. I don't own Amazon anymore because Jeff Bezos is no longer, I mean, he's still at the company. He is somewhat engaged, right? I wouldn't say it's a short, but he's kind of checked out a little bit, right? He's focused on, his new marriage, as well as sending Katy Perry to space. I'm not going to go there, etc. Yeah, but I will say that the new CEO of Amazon, Andy Jassy, not new, he several years ago, is the right choice because Andy Jassy created the cloud computing component of Amazon called Amazon Web Services. He's brilliant. Similarly, if you look at Microsoft, okay, so Steve Ballmer is just a brutal CEO. He's a bully, right? And so when Bill Gates kind of checked out to do the Bill and Melinda Gates stuff, Microsoft was a relatively good short. Now, when they decided Satya Nadella should be the new CEO, similar to Andy Jassy, that was the right choice because Satya Nadella actually started Microsoft's cloud division, which is called Azure. Yeah. Okay. Next question's from Leigh. Leigh wrote, are Ray and Tabo, people who've asked questions here, in your diamond classes, they seem so powerful than I in the silent generation before the Second World War, just asking, and good morning, good to see you. I don't think they are, but if you'd like to join my Diamond program where I do daily small group Zoom calls with you every single weekday, at least an hour every day. And I do over 300 hours as well per year. Then you can join. Let me show you guys very quickly, but I want to get on the next question. I don't want to make this an infomercial. Okay. All right. So the programs I have, and again, I'm launching a massive finance bootcamp program next week to get you guys jobs in finance. So I've got 3 products here, and you can go to HarounMBA.com and read about it. You got MBA Accelerator, MBA Executive, and Diamond, and all 3 programs contains. I think my internet just went down. Give me a second, guys. Hold on. Okay. All right. Internet is back. Sorry, guys. All right. So all 3 of my programs here, sorry about that. All 3 of my programs here contain over 500 hours of content and 30 MBA electives. I teach everything about business. Okay. And all 3 of these programs also contain 300 hours of weekly or daily calls with me, small group Zoom calls every single weekday for a year. That's over 300 hours. You got 500 hours of content you can get. They have lifetime access to online. Okay. You got 300 hours of group Zoom calls with me. So that's 800 hours. Plus, if you're in executive, you get 3 hours of one-on-ones with me Mondays through Saturdays. And if you're in Diamond, you get 10 hours of one-on-ones with me Mondays through Saturday. So if you're interested, again, go to HarounMBA.com and click on Learn More and set up a call with my team. And we're growing very, very fast. And my new goal is to do an IPO in 5 years. And the reason why I have to go public, I have no choice, I own 100% of my company, is because I will be a failure in my life if I don't build 1,000 schools in Africa. And I can't do it running the company the way I am right now. So what I do with the profits from what I do is I build schools. Okay, so I'm currently building one in Kenya with one of my wonderful students, Marin Koros. We're building the school in honor of her mother. It's going to be called the Leah Koros Memorial School for Girls. I went there last October to visit it. Got great support from Udemy and others. And here's what it looks like here. You can always go to that website you see up there if you're curious, okay? And then a couple years ago, I finished a school. I paid for this from the profits from my course in Rwanda with my students. Now, my goal is to build 1,000 of these things, okay? And this is with the Minister of Education cutting the ribbon and stuff. I'm going to build 1,000 of these things. Now, if the cost to build these things, right, there's got to be a higher purpose, high level calling. It can't just be about money. If you chase money, you lose your dreams. If you chase your dreams, you don't care what people think. Your dreams come true and money follows accident. I can't afford to build 1,000 schools running the business the way I am right now. Because if it costs me 100 grand per school, okay, to build, and we do it right, then 100 grand times 1,000 is $100 million. I don't have that cash flow for my business to do that. And that's why my 5-year goal is to go public. So we are hiring like crazy. If you're a student of mine, a former student of mine, you want to work in sales at my company, please send a message to support@harounventures.com with your resume. Thank you. We're hiring like crazy. Okay, let me get back on track here. All right, next up, Lay wrote, have you read Tribe of Mentors by Tim Ferriss? Any thoughts? I just started. It's so funny. Alexa, read my book.
Resuming Tribe of Mentors from Audible.
Alexa, stop. Yeah, so funny. Yeah. Wow. That blows my mind. Yeah. So Tim Ferriss wrote the 4-Hour Body. I think I read it years ago. This book, I'm excited because what he does, he interviews like 130 very successful people and puts together greatest hits of why they're successful. Athletes, business people, etc. I will get back to you on that next week. Thank you. And then you wrote, I'll come better prepared next week. No, please, this is great. And if you guys want, read that book with me as well. Listen on Audible. Yeah. I love it. Mallory, how are you? Mallory is one of my my platinum MBA students. Great to see you, Mallory. Mallory is based in London. She is going viral with her Instagram channel right now on how to cook, etc. Mallory, why don't you drop the name of your Insta handle here so everybody can follow you. Thank you. Good to see you. And I'm looking forward to seeing you later on today. During our Zoom office hours for my MBA students. Okay. Moving on to Jerome, who wrote, what does the DCF tell us about a business? And what are some of the things to look for? Yeah, so let me explain discounted cash flow. So what that means is this. So when you look at a company, what is a company worth? Well, it's worth the amount of cash it can make in the future and this year as well. So if you add up all the cash it makes in the future and today, that's the value of the company. However, you have to discount each future cash flow. Okay, and let me explain how that works. So I'm going to use a fake money prop because I'm a fake teacher. So if you have $100 today and the return, and you put it in the bank and the interest rate is 10%, what do you have in 1 year? You have $110. The future value is 110. Now, if I tell you 1 year from now, you're going to have $110, what's it worth today? What's the present value today? Well, if the interest rate is 10%, you discount it, it's roughly $100. And that's what DCF tells you, okay? And DCF takes it a step further because you have to use a special rate to discount the company as well, based on the cost of equity. So if the company has a high beta, it's going to be more expensive, and the cost of debt. And if the company pays high interest rates on debt, it's also going to make the weighted average cost of capital for the company much more expensive. I'm going to go through this very quickly. And for those of you in my MBA programs, you can ask me about this on our webcast starting in like an hour, our Zoom call. Okay, so the way discounted cash flow works, okay, is you're going to get free cash flow for each year. Now, free cash flow you get from the balance sheet, okay, down here. And free cash flow is income from cash flow from operations minus capex. All right. So once you calculate that for every single year, You're going to forecast that, okay? And then you're going to come up with a terminal value, meaning all future years, okay? Then you're going to calculate the cost of equity, cost of debt, and then you're going to discount all that stuff, all those cash flows using that rate, okay? And you'll discount that using net present value. I can go into more details in the math if you want me to, but let me keep moving here. Thanks. Okay. Yeah, you want to make sure that you look to see that the weighted average cost of capital for them is not too high. Yeah. And I can talk about each component in detail if you want me to. Okay. Hey, Arda, how are you? Wes, how are you? Good to see you. Okay. Jerome wrote, what is the difference between a 10K and a 10Q? Yeah, 10Q is a quarterly report, comes out 3 times per year. And the 10K comes out once per year. It's an annual report. And the 10K is usually audited, and there's way more information in it than with the 10Qs, meaning a lot more footnotes. And there's usually 10 to 15 categories of footnotes that tell you more stuff about the company in a lot of detail. And then the best way to analyze these things is, let me see right here. The best way is to read every single footnote in detail. And I have an upcoming course available to my students that's going to help you to be able to do that. Okay. You want to look at the audit report as well. We do tons of case studies in this. And what comes out of this elective is a 1-pager, okay, on the footnotes, as well as a massive write-up on the company, analyzing the footnotes. And you can bring these to interviews if you want to, or use it to help you, hopefully make money in the long run. I don't give stock advice, individual stocks. I teach you how to fish instead of giving you a fish. Okay. All right. Next up, Thabo wrote, to Laywood, I'm not in the diamond class. I'm just a big fan of Mr. Haroun's work, Chris's work, please. Oh, you're in South Africa. Excellent. I have tons of students down there. Yeah. And then you wrote, by the way, Sir Chris, please. When is the next Billions reaction video coming out? Yeah. And then you wrote, last question, I promise. No, please ask as many questions as you want to. You do me a favor. I love doing this. Yeah. So what I do, for those of you that look at my YouTube videos, what I do is I analyze movies and TV shows, okay? And I teach finance based on that. And actually one of the writers, there's 2 writers or 2 creators of Billions reached out to me and had really nice things to say about these videos. And a lot of people that actually worked on the show behind the scenes sent me messages saying, oh my God, this is great, I'm learning, thanks. So my most recent one is credit default swaps explained. I'm going to try to get one out probably next month. I've got a couple other things going on, but if you want to learn about credit default swaps and what that means, I explain it in a lot of detail right here. Okay. My marketing person wants me to say, please everybody please like the video, this video, and subscribe. Okay. All right. And then Mellory wrote, I love that phrase, confidently wrong. That's right. Yeah, AI products hallucinate all the time. Be careful. Yeah. You wrote, I feel like I was gaslit by people who were confidently wrong. Yeah, it's true. And I give a lot of corporate presentations. I gave a corporate presentation to a very large semiconductor, it's publicly traded here in the Bay Area. I presented to all employees. And the C-level employees told me this. They said, and I only present from my office, I don't visit people's headquarters. Okay, so if anybody wants to hire me, I don't travel because I want to be here with them and my wife. But one of the C-level executives told me during my presentation, and it was a presentation on how to sell, okay, told me that quite often they decide which vendor to buy from, meaning which salesperson to buy from, based on the level of confidence the person has during their pitch. And confidence leads to perceived competence. Now, I've been teaching in the United States for a long time. So when I worked in venture capital, I also taught at several Bay Area universities. I was humbly voted Finance Professor of the Year. And one thing I learned from teaching here, and mind you, 50% of my students, my in-class students at the Bay Area MBA schools, university I taught at, 50% of students were born outside the United States. But one thing I learned is that American students, regardless of where they were born, American students are #1 in the world in the most important economic category nobody talks about, which is confidence. With confidence, you can convince somebody to buy a product that's really boring. Like Mark Benioff makes cloud computing sound awesome, but it's a really boring topic. With confidence, Sir Richard Branson, who oozes positivity, can make you want to buy any of his Virgin products. So again, confidence leads to perceived competence. And in my MBA degree program and other programs, I teach you how to get rid of imposter syndrome. Okay? So that you can be unstoppable when it comes to confidence. It's like the Rodin sculpture. I think, therefore I am. Yeah. I got to go off script, guys. Okay. I know I showed this to you before, but I care. I care tremendously about my students. This is the most important chart you'll ever see. Okay? And I drew this on the back of this. Okay. So on the x-axis, we have your age. On the y-axis, we have give a darn. When you're down here, and I'm actually going to use a prop to point. And if you meet me in real life, I'm a tiny man. By the way, silver, gold, platinum, any MBA students, I have a 3-day graduation event here in the Bay Area. We're going to go to Napa Valley as well. If you're interested in attending, email support@harounventures.com. All right. So we got age here. We got give a darn here. When you're younger down here, like my kids when they were younger 8 million years ago, you don't have confidence problems. You don't give a darn what people think about you. When you're older, really old people don't have confidence problems. They just say what they want to say. It's kind of liberating. The problem is when you're teenagers, 20s, 30s, 40s, 50s, you're up here. You care what people think. What an awful way to live our lives. I want you to get rid of the triangle despair. And I want you to live at this level, okay? This is where the best entrepreneurs live. Steve Jobs, he didn't care what people thought. I'm not saying be rude or disingenuous. I'm just saying stop thinking about what other people think of you. The reality is they're not thinking of you. They got their own problems, their own mind. And if you focus on what everybody is thinking about you all the time, you don't have enough mental bandwidth to think about creating your empire. So live at this level like Oprah Winfrey does or Sir Richard Branson, etc. Don't care. Now, your homework. Everybody, get a piece of paper right now, please. Please. Please get a piece of paper and get a pen. And I want you to write this down. Ready? I don't care what people think of X. Okay? Again, write that down. I don't care what people think of X. And you're going to fill in the blank for X. And you're going to write down 10 times. Okay? And, for example, I don't care if people find out I'm wearing $20 really, really cheap track pants here that have 8 million pockets in the side. Or I don't care that my nose is massive. And whenever I put on this makeup stuff so my face is not shining, I run out really fast. Maybe I'm beautiful. Maybe it's Maybelline. Please tell me somebody understood that. I don't care that people judge me because I teach and I'm not a venture capitalist anymore. I don't care if I look silly right now, getting rid of the shininess on my face, especially my nose. I don't care if people, criticize me for being a teacher and not working on Wall Street. They say those who can't do, teach. And those who can't teach, teach gym class. And I suck at sports. You're all out of luck. I'm just kidding. I love teachers. But I'm right about those who can't teach, teach gym class. You know that's right. So I want you to write that down. I don't care what people think of X. 10 times. Get rid of imposter syndrome so that you can present and speak with confidence. Because confidence leads to perceived competence. All right, next up, Jeffrey wrote, hey, Jeffrey. Good day, Chris. How are you? Is it true that in Q1, the first 3 months of 2025, the U.S. economy shrunk by 0.3% and China's economy grew by 5.4%? What does that mean? I haven't seen the statistics yet, but I wouldn't be surprised if China grew much higher than expected. And the reason is because American companies, knowing about the tariffs, imported as much stuff as they could. I'll give you an example. Nintendo, for example, okay, a Japanese company. So Nintendo's got the Switch 2 coming out this June. I pre-ordered it because I'm a man-child. And what Nintendo did, right, to avoid the tariffs on the Switch 2 is they import as many Switch 2s as they could, and they're in massive warehouses now in America, to the extent that there's going to be a shortage in Japan. And as a result of all these companies, like Chinese companies, for example, American companies ordering lots of stuff from China to front run the tariffs. Of course, China's economy grew at a really, really high rate. I wouldn't be surprised if March wasn't 10% year-over-year growth for China. Now, obviously, growth is going to be massively negative for them in the next 3 months. Yeah. A recession is likely here. Yeah. I don't know for sure, but it's likely here. I'm surprised that the yield curve is not inverted. I can go there if you want me to. Okay. All right. And then Conquistador, thank you. First time seeing, and thank you for the $5 donation. That will go to building the schools. Thank you for that. Appreciate it. Yeah. And it'll go to charity, which is my wife's name. That was a terrible joke. I promise you it's going to those. It's going to the schools I'm building. Yeah. Now, just so you guys know, I don't have a charity in my name. Okay. I keep it separate. The charities are set up in Africa in the name of the student that's building the school. Okay, so I don't get any rebates and all that stuff. Okay, so Conquistador, thank you again, wrote, do you think there's a path for older individuals switching from consumer banking compliance into an alternative investment outside of investment banking? Absolutely, absolutely. And again, I have a finance bootcamp product that is launching next week where I get you a job in finance. I teach you everything. Okay, whether you're in finance or not in finance, know nothing about finance, or you want to transition to another job within finance, the program is for you. Set up a call by looking at the link in the description of this video, and we'll explain it to you in more detail, see if it's a good fit for you. Yeah, you can absolutely do it. But what I gotta say is that whenever you guys see a job opening online, you literally have a 1 in 250 chance of getting that job. And the person that gets a job ultimately knows somebody at the company. So you have to network. And what I do in my programs on my website is I teach my students how to aggressively network and add value in meetings, informational meetings, so they can get a job. And I've helped countless students. I have over 2 million paying students in every single country. Humbly, that's a Canadian when they brag, sorry. I'm proudly Canadian. I've helped students get jobs at Goldman Sachs investment banking, private equity, venture capital, finance roles in non-finance companies, yada, yada, yada. Yeah. But it all comes through networking. Yeah. Your network is your net worth, and relationships are always more important than product knowledge. Okay, center of the board donated $10. Thank you so much, guys. Appreciate that. God bless you. Who wrote, hey, Chris, I'm paper trading and took your advice about trying to hit singles and doubles, and it's working. Cool. Awesome. Now, when you say paper trading, please don't day trade. It can be swing trading if you want to, okay? Like 3 to 6 month time horizon, but look at fundamentals first, valuation second, and then technical analysis a distant third. Yeah. And then you wrote, my trades are mostly successful, but the P divided by I to date on Thinkorswim is negative. What is P over I? Price over investment. Yeah, I don't know what P over I means. Give me 1 second. It's fun doing these things live, eh? P over I explain to a child. Okay, probably not. P over I explain. It works in ChatGPT because I'm a man-child. P divided by I. Finance. Okay, if you're dealing with profitability index, okay. All right, profitability index. Cost and benefits. Yeah, I don't understand how to apply that when it comes to investing. Please provide me with more details, and then what I'll do is I'll help you out. Yeah, and answer the question. Yeah. And by the way, a little side note, for those of you that are interested in options, I teach that a lot in my MBA degree program available on my website. But if you do it, please do a paper portfolio on Thinkorswim, for example, before you invest real money, and never underwrite, meaning sell options. Yeah. Okay, center of the board wrote, oh, thank you again for the donation. You have to appreciate it. You wrote, okay, so P over I, profit loss to date. Okay, you did capital P, lowercase l. Oh, that's why. Okay, profit loss to date. All right, I understand. You wrote, my trades are most successful, but the profit over loss to date on Thinkorswim is negative. Why? Well, if your trades are successful, then your profit over loss should be positive. Yeah. Provide me with examples, please, so I can humbly help you. But I do like the fact that you're day trading, or pardon me, that you're paper investing initially. It's always a good way to go. Yeah. Yeah. Give me an example, and I'll humbly help. Thank you. Okay. Next question is: when you're building a financial model, you start with the data from the SEC filings, or from investor relations data, or from Yahoo Finance. Yeah. I usually go directly to SEC.gov, but investor relations, you can go there as well if you want to, but never, ever from Yahoo Finance. Now, the way to search for data, if you want to find the investor relations website, is you always use Google, because Google's a better search engine than the company's search engine on their website. So you go like this: apple.com investor relations. Okay, and then you'll get it this way. Yeah. Now you'll see here. Let's go through Apple's investor relations website really quickly here. Okay, so this stuff, and I want you to listen to all earnings calls. Okay, so today Apple is going to report AMC after the market closes. I want you to listen to that earnings call if you want to invest in Apple and update your financial model that way, right? But if you scroll down here, you'll see the financial data, and this is pulled directly from SEC.gov, and it should look the same. Yeah, exactly. So this is the exact same document. Yeah. So either or is fine, meaning SEC.gov or going to investor relations for a company. Okay, and then Ray wrote, can we upload the 10K in ChatGPT and the questions we need to answer instead of reading it on our own? How irresponsible is that ? Yeah, you certainly can do that. Yeah, you can definitely do it. Yeah, you just can't upload many documents to ChatGPT. You can do that though with Claude if that's available in your country. You can absolutely do that with ChatGPT. So you download the 10K in PDF format, as I just showed you the Apple example one. Then upload that. Just click on the paperclip button there. Upload that directly to ChatGPT and start asking questions. Yeah. But double check the data always. All right. Amr wrote, hey, Chris, good to see you. Good to see you too. Welcome to the House of Habibi. Yeah. Haroun, House of Habibi. Moving on to Rohit. Hey, Rohit, it's been a while. Hope you're doing well. Rohit wrote, what's your fund's core investment philosophy? How did it evolve over time? Yeah, so when I ran my hedge fund years ago, what I did was I invested primarily in two different sectors, technology and cyclicals. Because the correlation between those two is quite low from a risk management perspective, it made sense. Then I transitioned the fund into a hybrid fund and venture capital fund as well, where I had an investment pre-IPO in Facebook, Palantir, et cetera. Yeah. Okay, and it was depressing because in the fall of 2008, I was massively short. I remember one month, October, market was down 30% or something. We were up like 3 or 4%. And I came into work every day hoping to see bad news. It was depressing. Yeah. So I'm longer term focused now. Yeah. All right. You wrote, what was your biggest position ever? And how did you justify the size? Do you know how much to buy? Yeah. So I max out at 5% always. So if I go back in time in the fall of 2008, my biggest position was ticker GLD. Okay, it's a gold ETF. I like to own more gold in times of uncertainty, like right now, actually. Yeah. So gold is at an all-time high right now. And what I like about gold is there's a dearth, meaning limit in supply. And also, it's a fear index. And if you think about it, if the Chinese government, for example, is going to buy less United States treasuries, right? They own $700 or $750 billion of U.S. treasuries right now. They own about 2% of the United States debt. Debt is $36 trillion. But if they're going to own less treasuries, what are they going to buy? Probably more of this. And if they don't want to buy this, maybe they'll buy a little bit more Bitcoin. And so I humbly believe, do your research first. And I publicly disclose I've owned Bitcoin forever. I humbly believe Bitcoin at some point in my life, I don't know when, is going to be $1 million. At some point. But still, no position should be more than 5% of capital in your portfolio, even if there's a cure for cancer. Yeah. Okay. And then you wrote, what were the most painful lessons from your biggest losses, and what changed afterwards? Let me think about that. Painful lessons. I guess when I was younger, I focused a little bit too much on technical analysis, back in the 90s. The trend was your friend. Every tech stock went up in the 90s. It was awesome. And I learned just to be longer term focused. I learned, through School of Hard Knocks, to be very long-term focused and value companies based on my earnings estimates in 5 years. As Warren Buffett said, the longer the view, the wiser the intention. Okay. And then you wrote, what kind of indicators or data did you monitor that retail or even other funds typically overlooked? Yeah. So every day in the morning meeting at the hedge funds I worked at some of the biggest hedge funds in the world, I would always look at sentiment indicators, especially with software and internet stocks. Okay. I'd look at University of Michigan retail sales data on a monthly basis. A lot of people look at that though. I also looked at mutual fund inflows and outflows. A lot of people don't do that. And it's publicly available data too. So if you see that there's tons of mutual fund inflows, people putting money into mutual funds or ETFs or whatever it is, which these big mutual fund companies disclose, that's probably positive for the market, right? Because portfolio managers have more money and they have to deploy that capital, and vice versa as well. And you can always look at machine learning to be able to see if there's a regression analysis. Regression analysis is a subset of machine learning, and machine learning is a subset of AI. You can look at a regression analysis to see if there's a correlation between your favorite stocks, funds, etc., and mutual fund inflows and outflows. The data's out there. Yeah. Let me think. Other things. What else did I look at? I looked at the price of gold every day. I used to look at the price of oil as well. It's important, especially for cyclical stocks. Other than that, I was just very long-term focused. I looked at weekly unemployment claims and monthly jobs report as well, like everybody else. But really, really think long-term. Yeah, you'll sleep better at night too. All right. Next question is Manas from Calcutta. Good to see you, one of my silver students. Manas wrote, good morning, my dear mentor. Hope all is well. Good to see you, brother. Good to see you. Okay. And then Rohit wrote, if you're holding a stock and you're long, and if you get to know that there is some management issue detected, then do you book losses on that stock and avoid to invest in that company as well? Yeah. So let me tell you how I'm unemotional. Now, the most successful people in the world in business are unemotional, especially when it comes to investing. If you're a very emotional person, don't invest in stocks for the short term, please. Be long-term focused. And a lot of the billionaires I've worked for, I'm not going to name which ones, they're very unemotional to the extent that when we made a lot of money, one of our companies got acquired when I worked in the hedge fund industry. They weren't high-fiving. They were just kind of like this emoji. And then when we lost a lot of money, they were like this emoji as well. Yeah. Okay. Yeah, but okay. So here's how you be unemotional. Okay, about investing. I promise you what I'm about to show you will serve you well. All right. So I'm going to go here to the 100-step dashboard I created to invest in stocks. There's 100 steps, and students in my MBA program from my website, they fill this out, and what comes out of this is a one-page executive summary. This is dummy data here, and a massive detailed report. Okay. Now the first thing we look at is the management team up here. Okay, and they don't teach that in business school. Like, what is a company? It's the quality of the people running it, not what they do. So what you do is you go through all 100 steps, answer the 700 or 800 questions I have here. And it creates a one-page summary. Again, this is dummy data. And when I ran my hedge fund, I used to have hundreds of these, literally hundreds, on the wall. Okay. So let's say that you complete this one-page write-up. Again, it's dummy data here. You complete the one-page write-up. Great. And you bought the stock. Then 1 year later, news comes out that's really negative, and the stock goes down. What do you do? Do you buy more or do you sell? Here's what you do. You go back to the one-pager you made a year ago. You look at it today, and you read it, your investment thesis. This will make you unemotional. And you say to yourself this: okay, there's negative news on the tape today. The stock is down because of it. Had I known about that negative news item when I wrote my investment write-up here a year ago, would I have still bought the stock? If the answer is yes, buy more, as long as it's not more than 5% of capital. If the answer is no, I wouldn't have bought it given that negative news headline. Sell it and move on. It's kind of like the Senate. It's a sober second look. And my job is I provide you with tons of templates in my MBA degree program and other programs so that I can help you to avoid massive losses. It's the same thing with business plans. In my MBA program, my website, I also have a venture capital boot camp where I help you write a business plan. And failing to plan is planning to fail. You have to write a business plan. Most people don't. Yeah. And I help you with that. Yeah. Okay. Okay. Next question. I thought I was going to get this one today. Yeah. Manos wrote, Canada is again with Liberals for 4 more years. What do you think has changed? Poilievre lost the election as well and his own seat after 2 decades. But humbly, they were close to winning. Yeah, just my general thoughts. Yeah. Okay. So the way that Canadian political system works, I'll make this short, I promise you, okay, is you've got right wing, which is progressive conservatives, PC, okay, and that's Pierre Poilievre. And you've got Liberals, which is more left wing, okay, and Liberals just won. Okay, so don't ever share your political affiliation, but I'm going to with you because I don't care. And don't ever share this. Don't ever follow politicians on LinkedIn because half the people will like you more than the other half. I don't know which half. So Poilievre, who's more right wing, was like 20% ahead in the polls. And then once Trudeau stepped down, okay, and Mark Carney took over, and I overlapped with Carney at Goldman. He's great. They just gained a lot of momentum. The reason why Carney is the right choice for now, okay, although I prefer Poilievre, I think he's great because he understands global economics better than any political leader on the planet. Why? I mean, he worked at Goldman. They don't hire the smartest people at Goldman, by the way. But also, more importantly, he was the former head of the Bank of Canada and the former head of the Bank of England. And some people think that Carney may have had some influence on the coordinated sell-off between the Japanese government, the Chinese government, on U.S. treasuries several weeks ago that caused Trump to pause tariffs on all countries except for China for 90 days. So I think he's the right choice. One thing I don't like about Canada, and I'm very proud to be Canadian, is that there's no term limits. There should be term limits. When I was a kid, Pierre Elliott Trudeau was prime minister forever. I didn't like that. I went to school with Justin Trudeau as well. I can always tell you a story about that. Yeah. Okay. And you'll notice that Trump has a lot more respect for Mark Carney. Like, he doesn't refer to Canada or Mark Carney as Governor Carney, because he knows that this guy understands the relationship between treasuries and yields. And I can talk about that in much more detail if you want me to. Thank you. All right. Now, another reason why, really, really quickly. Okay, during times of war, what happens is usually the country comes together and approval ratings go up, right? This is not an apples to apples comparison. It's kind of silly. But after 9/11, Bush Jr.'s approval rating went to above 90%. And so with this trade war, it's very different, I know. But with this trade war against Canada, the approval rating of the political leader at the time went up. Yeah. Okay, let me move on though. Let's talk about happy stuff. All right, Tenchi, first time I see you on the call. I hope you join us again. So Tan wrote here, hey Chris, I'm Tan from Singapore. Pleasure to meet you. I've been a huge fan of you since my university days. I followed you for 9 years and considered your first batch student. Now I'm working in venture capital. Awesome. Awesome. It's a pleasure to meet you. Dude, set up a call with me. Go to the link in the description here. Yeah. Actually, what I'm going to do is this. I'm going to drop my personal calendar right here. And then I want you to set up a call with me. Okay. And anybody who wants to join my program as well or just talk to me, just click on that link. I just shared it there. Then you wrote here, during my university time, I bought almost all of your Udemy courses. Thank you. And my favorite is your book, 101 Crucial Lessons They Don't Teach You in Business School. Thank you so much for that. And Forbes humbly called this one of 6 books that all entrepreneurs need to read right now. along with Peter Thiel's book, Simon Sinek, and all those other people that speak way gooder than me. You wrote, I also enrolled in your MBA course. Yeah, if it's one on Udemy, it's that's a 7.5 hour course. The one on my website is 500 hours. It's quite different. Yeah, but again, book a call with me. I would love to talk to you as well if you want to. Thanks. And that goes for anybody else that might be interested in one of my programs or talking to me, whatever. The link is in the description there. Thank you, and God bless you. Yeah, and I'm very bullish on Singapore longer term. Very bullish, because from a geopolitical perspective, if less investment might go into China from the United States, it could go into Singapore once we get this trade war craziness out of the way. Yeah. Thank you. All right, next up, Manas wrote, a lot to ask. Sure, and Manas, you're also in one of my MBA degree programs, so you can always ask during the 1 hour Zoom. We'll start in about half hour. I'm always here for you. Yeah. All right, and I have daily small group Zoom calls as well in my newer programs. Click the link here in the description to learn more. Set up a call with us. Yeah, thanks. Okay. Manas wrote, why is Canada not good with technology and finance? I mean, they have Spotify. Yeah, so Spotify is not Canadian. I wish it was. Thank you. And big 5 banks. But why is innovation not happening there? Also, why is GDP smaller in your view? Yeah, so Canada has a lot of structural issues. One of them is called the brain drain, where a lot of people that could work in Canada go to the United States. Another issue is that Canada should have blocked a lot of tech acquisitions. Like AMD owns ATI, right? ATI was a graphics card company that was Canadian. The Canadian government should have blocked that. Yeah, that acquisition years ago. Like AMD is only relevant. Well, one of the reasons, aside from the Ryzen processor chips, etc., is because they bought ATI. Yeah, yeah. Plus, taxes need to be lower. I'm a libertarian. Okay, I believe in very extraordinarily low taxes. Yeah, I think that Canada's taxes are insanely high, ridiculous, really. Yeah, that's another one of the reasons. Yeah, in terms of not being good in tech, there's a lot of great startups that come out of Waterloo, which is in Southern Ontario. And now Elon Musk actually got into University of Waterloo in Canada. He chose to go to Queen's before he transferred to UPenn. He didn't, but he didn't go to Waterloo because he said it was harder to meet women there. That's what he said. Just saying. Yeah. But there's a lot of great startups. In fact, Microsoft used to only recruit out of 2 schools: University of Waterloo in Southern Ontario, Canada, and MIT. Yeah. Yeah. In terms of financial services, Canadian banks are very strong globally, but it's a more regulated system to the extent that, because Canada is more left-wing than the United States. It is what it is, right? And so it's a very regulated financial system where U.S. banks are really allowed to come in and dominate or enter as well. But Canadian banks are very strong on Wall Street. Yeah. Yeah. And because of that regulation, more conservative culture from a financial services perspective, Canada did not have the same crash with subprime mortgages we had in the fall of 2008 in the United States, when we were within 24 hours of bank machines not working. Yeah. I'm very proud of my Canadian roots. All right. Hey, Sean, how are you? Sean is in my Gold MBA program. Good to see you, brother. Looking forward to seeing you in half an hour for our weekly 3-hour Zoom call. You wrote, good morning, Professor. Good morning to you too, buddy. Can you talk about what hedging means? Yeah. Yeah. So the reason it's called a hedge fund is because of this. Think of your backyard. Around your backyard, you have a hedge. And that hedge protects your backyard. And so hedge funds do 2 things. Their number one focus is this: capital preservation through hedging. Their number 2 focus is make money. So hedging means you're a good steward of capital. You have good risk management metrics in place. So for example, if you're long a lot of software stocks, you should probably be short a couple of software stocks as well. Now, a lot of the best hedge funds in the world run what is called market neutral, which means they usually don't have more than 10% net long or net short the market, right? They're hedged. Yeah. And I can also talk a lot, if you want me to, about options. Yeah. But if you're interested in options, Sean, you can always go to FA44 in your curriculum. That's Finance and Accounting, semester 4, class number 4. Yeah. And then you wrote, what does a classic hedge look like? Yeah, for example, buying SQQQ calls right now be considered a hedge. Yeah, be careful with anything with leverage. Okay, be really, really careful. Also, I don't want you to short stocks, because if you short stocks, you could have unlimited losses. Let me give an example. Back in January 2021, GameStop, ticker GME, went up 29.4 times. And a lot of hedge funds lost their shirts. Melvin Capital, multi-billion-dollar hedge fund, declared they went belly up. Michael Jordan, according to people familiar with the matter, lost $500 million. Be careful with them. If you want to hedge, you consider buying a put. Okay, because when you buy a put, so a put is like, so you got call options, put options. So when you do fundamental research on a company, let's say that you complete one of my templates and you see 500% upside in 5 years for a stock, okay, based on your estimates. Well, how do you juice your returns based on that? Well, what you can do is you can buy calls, invest a little bit amount of money, and if the stock goes up, you make a fortune. If stock goes down, you just lose that. And I want you to buy what are called leaps after you do your research. Leaps means a call that expires in 1, 2, or 3 years. You can make a killing doing that. Let me talk about puts now. So puts are kind of like health insurance, or life insurance, I should say. So for me, I pay a certain amount of money every month. It's called life insurance. And I'm worth more dead than alive. It's true. So what that means is this. If God forbid I pass away, then the life insurance amount I pay goes up big time, right? And my family makes a lot of money, okay? But if I don't die, I hope I don't die. If I don't die, then every month I lose this month. That's exactly how a put works. So if you have too much exposure to a stock, sector, whatever, you can consider buying a put to hedge your exposure. So if that stock you own goes down a lot, this will go up a lot. If the stock goes up a lot, you're happy, you're making money on it, and all you lose is this much here. It's portfolio insurance. It's like a life insurance policy. That's it. That's it. Yeah. Okay. All right, next up, Adil wrote, hey, Chris, thank you for all your insights. Thank you for being here. Can you give us a primer on muni bonds, your opinion on them, how to evaluate them and buy them? Absolutely, sure. So bonds means debt. So governments issue debt. They issue bonds, okay? There's United States treasuries, right, which other countries buy. And the United States has issued and has $36 trillion in debt, okay, that's federal debt, from other countries owning our debt. The biggest owner is Japan. They own 2.7% of that debt, meaning well over $1 trillion worth. Now, municipal bonds means certain regions like Orange County, which is a location in Southern California, they can issue bonds as well. And they do that so they can, build roads or whatever it is, public works. Now, the good thing about investing in mutual bonds is you don't pay certain taxes on them, unlike federal bonds. So that's a sweetener for you. However, with municipal bonds, be careful. You can lose every penny, right? So, for example, Orange County about 10 years ago or so, maybe a little bit longer, they went bankrupt. And people that own munis or municipal bonds lost a ton of money. So when you do your research on municipal bonds, and you might want to buy a municipal bond portfolio or ETF, right, to mitigate your risk. When you do research, you want to make sure that the bonds are, at least AA rated or above. Now, the way the ratings system works, you've got Fitch, Moody's, and S&P. Generally speaking, here's how it works. AAA is the best, AA, A, and anything below that is BBB, BB, etc. Don't ever invest in anything below A. Those are junk bonds, or high yield bonds is a politically correct term these days. Yeah. Now, if you want to learn more about bonds, I have a video I made on YouTube, actually. Humbly very, very proud of it. Let me show you quickly here. So let's go here to my YouTube channel, okay? And just go to videos and then go down here. And this here is Bond Investing Explained, okay? And I use the TV show Billions to explain it. One of their episodes, I use tons of props. That's James Bond down there. Hi, I'm 6.5. I explain it with the yield curve. I have tons of props explaining treasuries, yield to maturity, coupons, everything from scratch. And what I'll do is I'm going to drop this link. It's 36 minutes. I'm going to drop this link in the chat here. I'll write bonds. There you go. Okay. Now, apparently I can drop in links in chat, but you guys can't. I don't know why YouTube set up that way. It is what it is. All right, let's move on now to the next question. Thank you. Okay. Give me 1 second, guys. I read every question, by the way. I'm just lost right now. I'm having a senior moment. Don't buy my courses because the older I get, the better I make. Okay, it jumped on me. I'm going to search for the word munis. Oh, here we go. I found it. Okay, good. Next question is from Awes, who wrote, "Hey, Chris, I'm now in EMS 4-2. Okay, in my MBA degree program you signed up for. You're in the lecture Economics Management Strategy, Semester 4, Class 2, Topic 1. How frequently should I update my research on a company I've invested in?" Yeah. So the way it works, the way professional money managers do it, and the way you can do it, and remember, professional money managers have no edge on you. By law, given Regulation FD, meaning fair disclosure, everything they use, you get access to in real time as well. So let me show you very quickly. So if we go here, you're in EMS 4.2 where I have this 100-step dashboard here. What I want you to do is I want you to update your financial statements, okay, every quarter, okay? And so, for example, if you invest in Apple, and Apple reports AMC today. If you're watching the replay of this, it's May 1st today. So Apple reports at 2 p.m. Pacific time today. Then they're going to have an earnings call. So what I want you to do is the second the 8K comes out, meaning the quarterly press release for Apple on sec.gov, I want you to update your financial model. Then what I want you to do is listen to the earnings call today, okay? And the details in the earnings call, the webcast, is in that press release. I just talked about the 8K. Then I want you to update your financial model in real time, all the numbers. And whenever the CFO or an investor on that call asks a question about a certain number, like say, I don't know, sales and marketing, R&D, or G&A. I want you to right click on that item, okay, that number for the quarter, and I want you to put in a comment. Like the CFO said, for example, R&D was 2% higher than it usually is. We expect it to come down. For example, I want you to put that comment in. And I want you to put comments in every single cell and listen to every earnings call you can for the past 10 years. And that is going to help you forecast the future. Okay. These professional investors have nothing on you. Okay. You can run circles around them. Okay. Give me 1 second here. All right. Let me move on now to the next question. All right. All right. Next up, I've got Ray wrote, "Do you think Trump will stop being provocative? I don't think so. This will last through his whole term." Yeah. So here are my humble thoughts on Trump. So generally speaking, when people are negotiating, party A says, I want this, party B says, I want this. They meet here. The way that Trump negotiates, and he is good at negotiating, okay, love him or hate him, okay. I didn't vote in the last election because I didn't approve of either candidate. But the way that Trump does it is one party says, I want this. And Trump says, oh, I want this. And then instead of meeting here, maybe they meet here, okay? Now, am I upset with what's happening? We all are. But I'm going to call a spade a spade. We don't know what the long-term implications are, okay? We don't know. Maybe 10 years from now, we'll look back and say this was brilliant. And I know it's a controversial thing to say. I get it. But I'm trying to be intellectually honest and unemotional. So it's not fair. I'll call a spade a spade. Okay. Now, the way he did it, I would have done it more gradually if I were him. Okay. Hindsight's 20/20, like smaller increases over time. But the reason he does it is because when the United States exports stuff to Europe, for example, in some countries, there's a 20% VAT tax, value-added tax, import tax. So that means that if Ford, which stands for 4 old rusty doors, I'm just kidding. It stands for found on road dead. I'm just kidding. Ford stands for fix or repair daily. I'm an idiot. You know I am. I'm kidding. But when Ford exports a car to Europe, right, it costs 20% more. I don't see many Fords in Europe. Do you? That's not fair. That is not fair. And the United States didn't until recently have taxes like that on European cars. That is not fair. And if you go to YouTube and you do a search, and I remember watching this when I was 15 years old back in the 80s. I remember seeing an interview with Oprah Winfrey and Donald Trump. Trump said it back then, that America is getting ripped off. I understand that. And so he's trying to shake up the system to the extent that America does not get ripped off as much as it does. I get it. I get what he's doing. Now, it doesn't matter if tariffs on China are 135% or 1,000,000%. Okay? Trade is going to, it's going to come to a standstill. Will they get this resolved soon? I think so. I think they will. And Trump knows there's too much at stake. Now, I don't think that Trump really thought that China would react the way they did and hold the line, because China has a lot more to lose than the United States. China is more dependent on America than vice versa. It's true. And the biggest concern of the Chinese government is if GDP growth slows a lot and there's civil unrest. And maybe Trump knows that, maybe he doesn't. So let's go back in time. It's 1989. CNN, by chance, happened to have a camera crew in Tiananmen Square in China. There was uprisings. And that's the only reason we heard about it, was because of that. Now, fast forward to today, China has 1.5 billion people. Let's just say that there's close to 1 billion of these things, or whatever. Everybody is CNN now, or Fox News, sorry. Same thing, sort of. Everybody has a camera crew in their pocket. And if there's any sort of civil unrest in China, China's going to want to make a deal. Okay? I think that's a big concern. A big concern if economic growth slows. And I'm worried about it too. And I pray daily that we have peace. And that places like Taiwan, there's no, I'm not going to go there. I'm not going to go there. But I think that when push comes to shove, both countries have too much to lose. China has more to lose in terms of coming up with a deal. Yeah. Okay. When I look at what happened in the 1920s, we had the Roaring '20s, and there was a stock market crash and the Great Depression. And then, big tariffs were put up, and then World War II started. My biggest concern is geopolitical instability longer term. And again, I pray that we have peace. And I think the only way we're going to have peace, or higher probability of peace in the long run, is if we get a deal done soon, which I hope happens. It's a gamble, that's for sure. Okay. All right. Cheesecake wrote, can you show examples for ROE and ROA? Yeah, absolutely. So whenever you hear the term return on whatever, it means net income divided by whatever. So return on equity means for every $1 in equity, meaning ownership in a company, how many pennies of net income are you making? And I'll show you an example in a second. So if return on equity is 25%, that means for every $1 in equity, meaning ownership you have in a company, okay, you're making 25 pennies. When you talk about return on assets, asset means stuff you own, like a car, house, whatever. And if a company has return on assets of 10%, that means for every $1 in assets you have, you're making 10 pennies. Now I'll show you an example using one of the templates that are exclusively provided to my MBA degree program students. All right, so I'm going to go over here. Yeah, we'll look at this one here. Okay, good. So I'll go to financial ratios. Okay, so right here, we've got return on ratios, okay? And this is from the income statement and the balance sheet. So return on assets, return on equity, okay? Net income's from the income statement, and then assets and equity here is from the balance sheet. So we want to see a gradual increase over time, okay? And if you're in my MBA degree program, I can tell you during our Zoom calls starting in 15 minutes where to access this file here. But all the data is linked right here, right? So right here, it's actually right below me, you can't see. Here's net income at the bottom, okay, in row 57, okay? That's where the denominator comes from. Let me go back here. And then the numerator comes from. And the denominator is going to be assets on the balance sheet, right? So I can take you directly to sorts, right down here, row 25. Okay, let me go back to the next question here. All right. All right, next up, Tanji from Singapore. I'm looking forward to doing a call with you as well. It's great to hear you work in the venture capital sector. Thank you. So Tanji wrote, how can I build a perfect or better DCF for a publicly traded company, given that retail investors always face an information disadvantage, or should I use trading multiples instead when valuation? Yeah, so you don't have a disadvantage. Like, a lot of people don't know this. And when we do our call together, if you want, right, just use the Zoom, the Calendly link I put there in the chat. When we do our call together, I'm going to show you where to get all the information. But by law, you and I, meaning us retail investors, we have the same access to information that the hedge funds and mutual funds do at the exact same time. By law. Okay? And you can get that from sec.gov or the investor relations website. And every time that the CEO or CFO of a company gives a public presentation, if they're going to release new information, it has to be webcast. They can't just sit in a room and tell a billionaire hedge fund, yeah, the market doesn't know this, but, you know, our revenues are going to be higher than expected next quarter. Like, that's the law. Otherwise, the hedge funds, when they trade on it or even know about it, they can go to jail. Yeah. We have the same advantage. So you always want to go to sec.gov, investor relations, etc. Okay. And what you can also do is you can set up an alert. Go to alerts.google.com and set up alerts for companies that you follow, so that you can get an immediate email to your Gmail account the second that news comes out. We have access to the same information at the same time that a lot of these mutual funds and hedge funds do. I promise you. Okay. Yeah, and in terms of making a perfect DCF, it's in the templates I showed you as well. All right. Next up, Manas wrote, which country will be good in 50 years, Russia or Canada? I love Canada as you do because of my maternal side. Both economies are resource dependent, also too cold and chilly. Yeah. So I would bet more so on Canada because of the ideology. I despise communism. I hate it. Yeah. I believe in capitalism, democracy, etc. So Canada, hands down. Now, any country that has a lot of natural resources is going to do extraordinarily well in the long run. Why? This is really silly. But obviously, we know that the amount of natural resources out there is going to go down and the price is going to go up. And if you invest in a product or a company where supply is limited and prices are going up, that's a home run of an investment. And so there's three primary economies that I think are great to invest in when it comes to natural resources. Okay? Canada, Brazil, Australia. And when the price of oil and natural resources go up a lot in the long run, the Canadian dollar, the Brazilian real, and the Australian dollar go up. And the reason they go up is because China, for example, which has a voracious appetite for natural resources, they have to, when they buy oil from Canada, they have to convert the Chinese yuan into Canadian dollars and then buy oil from Petro-Canada or whatever company they're buying it from. So that increase in demand for the Canadian dollar makes the Canadian dollar go up. Yeah. Canada has structural issues right now, obviously, because of these tariffs. And for Americans on the call, please understand that at sporting events, if Canadians boo the national anthem, that is not disrespect to Americans. It's disrespect to the policy of trade. Canadians love Americans and vice versa. Yeah. Okay. Hey, Shelly, how are you? Good to see you. Shelly's also in my Gold MBA program, along with her husband. Yeah, great to see you. And Shelly's also part Canadian. My people. All right, Michael Pope, who's in my Diamond program. Great to see you, brother. Michael wrote, what do you think about SCHD's method for ranking individual stocks? What's SCHD? Give me 1 second. Let me go there really quickly. Okay. And we got about 10 minutes, guys, left. So if I don't answer questions, you guys can ask me on my Zoom calls for my paying students. Okay. SCHD. Schwab. Okay, good. Got it. All right. So Schwab. All right, and I actually met Charles Schwab and his wife at a party in Atherton. I think it was like 8 or 9 years ago. Yeah, and Reed Hastings was there as well, and he was presenting. He's the founder of Netflix on the future of education. And I think it's not that far off until Netflix has online streaming of courses. And of course, I'll be there. Yeah. All right. What do you think about Charles Schwab's method for ranking individual stocks? Okay, cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Yeah. So so I'm longer term focused. So the second you mentioned 5-year dividend growth rate, I like that. I'm a bit more of a growth investor though, and less so value investor. So it doesn't really appeal to me. But if I had to rank it, I would say 5-year dividend growth rate comes first. Cash flow to total debt ratio, maybe that should come first. Cash is king, and I think that cash flow, free cash flow, net income conversion in the long run, that's important. Return on equity, that's important as well, which we know is net income over equity. And then lastly, dividend yield. Now, I don't look at one dividend yield. I look at it over time. And if you ever see a stock, right, you're doing research that has like a 20% dividend yield, it's a lie. Why is it a lie? Because it's not sustainable. It might be a one-off. You got to do your research, read the investment prospectus, or sophisticated investors are saying that this company has material issues and could go bankrupt, or the data is wrong. Yeah. Okay. All right. Next up, Manas wrote, do you think in 4 years China will be more or less powerful or less impactful because China is hard this time, not giving up, also being adamant on tariffs to, what are your thoughts? I don't know. I can't, I have no idea. And it's so hard because there could be, so there's a great book you guys should read by Nassim Nicholas Taleb, Lebanese dude. I'm 25% Lebanese represent, called The Black Swan. And the black swan refers to events we can't forecast that makes the markets go massively down usually. For example, 9/11, 2008 financial crisis, okay, COVID, as well as tariffs, like this tariff war. And these are, we've had 4 once-in-a-lifetime buying opportunities in our lives so far, right? So I have no idea, okay? And that's why I'm not a day trader. And I don't believe in day trading because stocks go up and down in the short term because of stuff you can't forecast. Yeah. Yeah. I just pray for peace. Yeah. Yeah. All right. Next question is, can you explain terminal value and discounted value? Because that is so confusing and complicated. Thank you. Yeah. What I'll do today in our Zoom call that starts in 8 minutes is I'll show you. Okay. But I'll briefly mention it right now without going into too much detail. Okay, so when we do discounted cash flow, okay, and you have access to this in your curriculum, okay, when we do discounted cash flow, give me a second. Okay, good. Discounted cash flow. What we're doing is we're forecasting what cash is going to be longer term. Okay, and this formula here is cash flow from operations minus capex. What about years 11 to infinity? Well, what we do is we create what's called the terminal value. Okay, and it's ridiculous, because the terminal value quite often can be 90% of the value of a company if you change one little metric. And so the terminal value is defined as forecast this out one more year and account for long-term growth, okay, which is usually 1%, 2%, or 3%. Then you're going to discount that back into today's terms. I'll go through the math in more detail during our call starting in 7 minutes, if you like, our Zoom call. You had another question buried in there as well. Okay. Yeah, discounted value. So what we do is we discount the cash flows using the weighted average cost of capital, meaning the cost of equity and the cost of debt. And what I'll do is I'll go through this in a lot of detail with you during our call that starts in 6 minutes. Yeah. Okay. Let me move on to the next question here. And I won't be able to answer all these questions, guys. So if you're in my MBA degree programs, especially the ones where I give you daily small group Zoom calls, I'll see you later today. Otherwise, you can ask questions next week. Okay. All right. Give me 1 second. Okay. Okay. Next question is, buying a house in California is literally impossible. Depends on the area. Yeah, in the Bay Area, it's expensive. You wrote it's impossible, it's expensive, whereas buying in Indiana is expensive, but still affordable, but value of houses in California will rise more than Indiana. What are your thoughts? Yeah. Yeah, no, it all depends on the affluence of the area, right? So in the Bay Area, Alexa, stop. I got to wrap up the call in a second. But in the Bay Area, there's a dearth of land, right? There's a lot of land that's protected, so you can't really build except building up, I guess, right? And as Silicon Valley grows, so too do the price of houses here, right? And there's so many liquidity events here in the Bay Area. I remember I moved here in late '04. And then, Google went public and the value of all real estate went up because 5,000 new millionaires were created here in the Bay Area. Google was based at the time mainly in Mountain View. And then in, I think, 2007 or 8 or something like that, Twitter went public. You had 1,000 new millionaires in the Bay Area. So it is what it is. Yeah. Okay. All right, guys. All right. And then Mallory, I can answer the question in more detail. I think you get daily access to Zoom calls, I think, with me. I can answer that in more detail later today. In terms of recommending S&P for non-U.S. people, I think that everybody should have U.S. stocks exposure and the S&P 500, perhaps after you do your research, in your portfolio, regardless of where you live. But if you're outside the United States, don't make it too big a percent of your portfolio because you're exposed to U.S. dollar risk. Yeah. And I can talk about that in more detail later today during our Zoom. Okay, next question is, when should one move out? Also, did you feel while moving out? When did you move out? I mean, 5 million years ago. Yeah. So I was on the road all the time. So I moved out when I was 18. I went to McGill University in Montreal. I had a lot of fun. I learned how to do this and other stuff too. No regrets. I don't drink anymore, but I don't drink any less. And then I was on the road for 4 years when I worked at Accenture. They sent me to overseas and all that stuff, do consulting. Yeah. Okay. But I didn't need to rent a place. So I had a place in my parents' house, but I was always out of town. Worked out well. Yeah. All right. Next question is from Thabo, who wrote, I've been struggling to find the FAANG ETF. Have you ever come across one? Yeah. So go to etfdb.com and there's 5,000 ETFs listed there and you should be able to find it. Yeah. And FAANG is kind of old school because the F is for Facebook. I guess it's Mang now, right? Because Meta. Yeah. Okay, next question is, and I'm going to have to wrap up in a second. Again, if I don't answer your questions, save them for next week or I'll ask you guys on my Zoom calls. If you guys want to set up a call with somebody on my team or myself, talk about joining one of my programs where you get daily small group Zoom calls. I coach you and one-on-ones as well. Go to the link in the description, set up a call, please. Okay. All right. Next question is, according to people familiar with the matter, which is euphemism for the media has insider information they're not trading on, but they're sharing it with us. According to people familiar with the matter, Tesla's board is replacing Elon. They're looking into it as a hedge, right? And as a result, I think that Elon is going to quit Doge any day now, meaning within a month or so. Yeah. Do you think Tesla will work without Musk? So Musk is sort of, I consider him a founder, more or less, of Tesla. If he's no longer there, I would never own the stock. I invest in people first, companies second. Yeah. Okay. Center of the board wrote, hey, Chris, I'm chasing my dreams and I'm still broke, LOL. Yeah. Be long-term focused. We'll be okay. Yeah. Manas wrote, IPO in 5 years. My company, the ticker is going to be HEVC. That'll be Haroun Education Ventures Corporation. Right now, I'm an S Corp, but I have to change to a C Corp because you have to be a C Corp in order to take over 500 investors, that sort of thing. Yeah. Okay. Manas wrote, made my day. Well, I'm pumped now and love it. But don't you think ICO be cheaper and faster? Meaning initial coin offering. I will never do cryptos. Ever. Yeah. Never. Never. Yeah. And Superfly wrote, will India attack Pakistan? I pray for global peace always. I'm not familiar with. Yeah. No. Okay. There's a question about Udemy stock. I signed an NDA with the company. Udemy is a partner of mine. I advise and all that stuff. So it wouldn't be ethical for me to give any advice on that company at all. But I do love the firm longer term. That's all I can say. Yeah. There's conflict of interest. All right, Alexa. Shh. By the way, you can whisper to ALEXA as well if you want to. Yeah. All right, guys. So I know there's lots more questions, tons more actually. So if you're in my one of my MBA programs, you can ask right now during office hours. Let me wrap this up real quick. I'm running behind schedule. But if you want to learn more about my MBA degree programs, I'm going to provide a link right there in the chat. You can go directly to that. I've got Accelerator, Executive, Diamond, which includes 10 hours of one-on-ones. Click the Learn More to set up a call with us to learn more. God bless you guys. And I will see you guys next week and every week at 8 a.m. Pacific time. Thank you.